Hey everyone, this is Bob Brooks, host of the Prudent Money Radio Show. Just got through interviewing IRS expert Dan Pilla. And of course, as you know, if you listen to the program, Dan comes on once a month and talks taxes. Probably one of the most experienced tax IRS experts in the country. And lucky to have him on as a contributor. And he talks about cryptocurrency and the complexities that goes into reporting what you're doing with that crypto to the IRS and making sure that it is accurate on your tax return. This is going to be very important. It's very complex, and the IRS has got a big target on people who are trading crypto and especially using. And you got to be, you've got to make sure that you're classifying this right on your tax return. Even if you're using crypto to buy goods and services, you could have tax implications. So make sure you listen. And if I can do anything for you, you always go to prudentmoney.com. You can send us an email, info@prudentmoney.com, and we'll get you taken care of whatever you need to get helped out. Thanks for listening, and keep the faith.
This is Pastor Lutzer of Running to Win, heard daily on Bible School Radio, 91.3 KDKR, Decatur, Dallas, Fort Worth, and on 91.3 KYJC, Commerce.
Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, if you are a crypto investor, you're going to want to stay tuned. Today we're going to take a look. Stay tuned for Prudent Money. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, crypto trading and the IRS, everything you need to know. IRS expert Dan Pilla is here with me today to talk about what to do and maybe what not to do. Hey, Dan, it's good to have you on the program.
Hey, it's my pleasure to be here, Bob. How you doing?
I am doing great. I was thinking about, as we kind of gear up, we're getting obviously past the midpoint of the year. There's a couple of big tax issues that are coming down the pike people need to know about. And one, of course, we'll get to second, but I'll go ahead and introduce that one and talk about cryptocurrency. It's a big topic that I don't think people really understand well enough to do the right things on their tax returns. And then the home office deduction. With people still working from home, and I thought we would get some of that cleared up. You know, most of the time, and we've talked about this in the past, Dan, is people want to stay away from the controversial write-offs. You know, this is going to get me audited. I don't want to do this. Yeah, I could write it off. I legitimately use it. I mean, first, comment on what you should do if you do have a legitimate write-off.
Well, the short answer, Bob, is you should claim it. If you're legally entitled to claim the deduction, you should claim it on your tax return, because if you don't, that just simply means you're paying taxes you don't owe. Nobody's got a responsibility to pay more taxes than they owe. Your responsibility is to report your income correctly, claim the deductions you're legally entitled to, calculate your tax liability based on the law and the facts of your case, and pay the taxes. You don't have a responsibility to pay more than you owe. And I hear this from people all the time, and I've heard it from people for decades. I've been in this business for over 40 years. I've heard it all that time, that people will withhold claiming deductions on their tax return for fear of being audited. Well, that's a mistake, because for one thing,
right,
just because you don't claim a deduction doesn't mean you're not going to be audited, all right? But if you aren't audited, and frankly most people are not, if you're not audited, that simply means that you increased your tax liability above and beyond what it should have been. So claim the deduction, but make sure that you understand what the rules are for supporting the deduction you claim, and make sure you got the documents to support it. I talk about this extensively in my writings over the years. I show you exactly how to do that so you don't have to fear an audit.
So talk a little bit about you've got a tremendous amount of resources at taxhelponline.com. What would be the best resource for somebody to come get real detailed information?
Well, it depends on what kind of detailed information we're talking about. If you're talking about dealing with an audit, then the book is called How to Win Your Tax Audit. If you're a small business person and you're looking for how to stay compliant with the IRS in the convoluted area of business tax law, then you need my book, Dan Pilla, Small Business Tax Guide. If you got a current problem with the IRS, that is to say you owe them money that you can't pay, you're dealing with wage levies or bank levies, or the IRS has a tax lien filed against you, or something, something of that sort of collection problem, then you need my book, How to Get Tax Amnesty, which is the seminal guide to negotiating settlements with the IRS. And I walk you step by step through 4 or 5 different programs that are available to reduce or eliminate your tax debt that you owe and can't pay. So again, it depends on the nature of the problem.
But I think the bottom line is if you got an issue with the IRS, Dan's got a resource for you. TaxHelpOnline.com is the website. Let's talk a little bit about some of the rules of whether or not you can legitimately write off a home office.
Well, yeah, the first rule is that, the first answer is that yes, you can write off a home office if you qualify. Now, the question is, do you qualify? You mentioned in your opening remarks, you alluded to people that are working from home. Well, let's talk about that because that's a real problem, Bob. If you're an employee working for another company and you are working for home under COVID orders or whatever, just because the company decides they should have people working from home, you don't get to write off a deduction for the space used in your home. And I'll tell you the reason for that is because as an employee business expenses are no longer deductible as of January 1st, 2018, the Tax Cuts and Jobs Act. All right, so the Tax Cuts and Jobs Act eliminated miscellaneous itemized deductions for workers, for employees, right? But it doubled the standard deduction. So what you lose in itemized deductions, you make up for, in fact, for most people, they more than make up for in the form of a doubled standard deduction. Your standard deduction for a married couple went from about $12,400 to over $24,000, almost $25,000. So it about doubled. So people say, I can no longer take my employee business expenses. That's true, you can't. But you get twice the amount of the standard deduction that you were otherwise entitled to, so it more than makes up for it. Now, if you're a self-employed person, all right, you're running your own business, now that's different. That person may be able to claim an office in their home if they have a space in the home that's used regularly and exclusively for business purposes in the performance of tasks that are necessary to the success of the business, and they have no other place to perform those tasks. All right, so those are the general rules. What we mean by regular and exclusive is very important. All right, regular has to be more than just sporadic or occasional. It's got to be something that's done on an ongoing basis. It could be once a week or twice a week or twice a month, but it's got to be regular, not just sporadic. All right, but now, exclusive use, that's the key thing that people need to understand. You can't, let's say you got a spare bedroom that you're using for your office, and you got your desk and your chair and your file cabinet and your telephone there. Okay, that's great. But if that room is used for an office during the day and then for a bedroom or a playroom at night for the kids, or the grandkids sleep there on the weekends, that's not exclusive use. That space in your home has to be used exclusively for business. That means there can't be any other things going on in that room besides the business use. And then when you meet the regular and exclusive business use test, then you get to deduct a pro rata portion of the costs of maintaining the home as a business expense. So, for example, let's say your house is a total of 2,000 square feet and your office is 200 square feet. Well, you've got 10% of the space in your home is used for business. So now you get a 10% deduction for utilities, 10% deduction for maintenance, lawn care, snow removal. You get a 10% deduction for your real estate taxes and so on. All right, so that's how it works. There is a separate form that you have to file with the IRS, Form 8829, that goes with your tax return, that lays out on the tax return exactly what the basis for your claim is, and that's how it's done, Bob. In my book, The Small Business Tax Guide, I have a chapter in there that shows small business owners exactly how to calculate this home office deduction, and I take you step by step through these important definitions of regular and exclusive business use.
I guess the question that comes to my mind is, you're sitting in front of an IRS agent. I mean, how do you prove that it's exclusively used for work? I mean, you didn't come into your office on a Saturday afternoon and sit down in your big chair and watch TV. That's and you can't write the man cave off, right? So
Right. That's exactly right. Well, that's a darn good question, Bob, and that question comes up in a lot of different ways, context when we're dealing with the IRS, and home office is one of the key ways. And the way you prove that is with an affidavit, a written statement that's very specific, very detailed, that provides information to the IRS relative to what the issue is that we're talking about here. And in that affidavit, you would declare under penalty of perjury that the office space is used only for business activities, and you delineate the activities. We make phone calls, we bill our clients, we do internet research, whatever it is you do, 3, 4, 5 different things, 8, 10, 12 things that you're doing in your office, whatever it is, and you do it on an ongoing basis, and you describe those things, and you would make the very specific declaration in that affidavit that the office is never used for personal purposes. All right, that provides the burden of proof. It is important for people to understand how affidavits work and what purposes they serve in the audit environment, because there are some circumstances, Bob, where you don't have a piece of paper. The kids aren't going to give you a receipt, right, that says Dad won't let us play in the office at night. I suppose you could get one from the kids, but a statement under penalty of perjury from a minor is really not all that compelling. So you're going to have to use an affidavit strategy. Now, the affidavit doesn't apply just to the home office. It applies to a number of different things where you're not going to get a receipt for a particular item. For example, your mileage log. In order to write off your automobile, you need to keep a mileage log, and you need to demonstrate with that mileage log how many miles you drive per year and how many of those miles are business miles. And you need to establish that the miles you claim are driven for business purposes are in fact driven for business purposes. So you need a log to show that, and your affidavit is going to have to verify that your log is made on a contemporaneous basis and the entries made in the log are true and correct under penalty of perjury. This turns the mere statement into a declaration under penalty of perjury, Bob. It's as if you made the statement on a witness stand in a courtroom, and it's very compelling.
Tell me this, and this is just out of curiosity, would love to hear your opinion. Are you surprised that this trend that, obviously started during the pandemic, but this trend of employees working from home and the way all this has turned out, that it's still going strong? I'm very surprised. It's turned into a way of life.
Oh, I'm not surprised at all. As a matter of fact, Bob, I vividly remember in probably around June of 2022, I was doing a radio show. Might well have been with you, Bob, but I can't say that for sure. But I did a radio show where I stated that employers are quickly going to discover that they don't need all this expensive square footage to run their businesses, and that 5 years from now you're going to be getting down and dirty deals on 14-story office buildings in downtowns around the country. They're going to be empty, and they're not going to fill back up again, and I think we're seeing that now.
Yeah, no, I think we're starting to see the problems that we have anticipated in the real estate markets. It's going to be interesting to see it come to fruition. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Once a month, Dan Pilla, IRS expert, comes on the program, talks taxes. If you want more information, a lot of great resources, taxhelponline.com is where you go. So let's talk a little bit about the main subject of today, which is cryptocurrency, and your latest edition of Pilla Talks Taxes. Pilla Talks Taxes.
Pilla. Bob, Pilla Talk, what are you doing?
Oh, God, it's been a long day. At any rate, thank you very much. You talk about taxes and cryptocurrency. Obviously, a lot of people trading cryptocurrency, using cryptocurrency. This has turned into a top target by the IRS. What are they looking for, and could this be an audit trigger?
Well, it absolutely is an audit trigger, Bob, and that might be, cryptocurrency might be the number one thing on the IRS's list of aggressive enforcement initiatives that they are pursuing. Every year they come out with a list of things that says, this is what the trend is in tax noncompliance, and these are the areas that we're going to go after. About 2/3 of the returns that are selected for audit, Bob, are selected just on a random basis, just on a basis of series of numbers that computers use to select returns for audit. But the remaining third are selected for audit based on these so-called audit initiatives. And the top initiative on the list now these days, and has been for a couple of years, is cryptocurrency compliance. Many people believe that their crypto transactions are not taxable. Many people believe, Bob, that the crypto transactions are secret from the IRS and private and can't be reached, and that is absolutely not true. As a matter of fact, my July newsletter, and it's just being released now. I don't think it's out yet. My July newsletter has a story in it about an IRS summons. It's a so-called John Doe summons that was issued by the IRS to one of these crypto exchange platforms. Mm-hmm. And the platform that it was issued to is called Kraken, and a lot of people probably have heard of it. This is the Coinbase, and another one was Coinbase,
mm-hmm, right.
Another crypto trading platform. Both of these companies had summonses issued against them by the IRS looking for all of the data that these companies have on U.S. citizens that have accounts with their companies, and those summonses were both enforced by federal district courts in California. So the IRS is getting the records, Bob, and they're going to know about your crypto transactions. So you need to understand how these crypto transactions can be taxed, and there's a lot of different tax consequences to crypto. We can go through some of those if you want, but there's a list of them that people need to be aware of.
It makes me wonder. There's a lot of teenagers who are doing things with buying and selling crypto. Are they going to go after the 17 or 18-year-old? I mean, are they looking specifically for potential tax? I don't know. What are they looking for?
Well, that's a good question. Are they going to go after teenagers? Well, they're theoretically going to go after anybody that didn't report taxable crypto transactions on their tax returns. Now, there's even a question on the return, Bob. You might have noticed this on your tax return, and it's right at the top of page 1 of the 1040 form. So this is how serious the IRS is about this. They require you to answer 2 questions, yes or no. Have you traded in crypto during the course of this year, and have you received any crypto in exchange for services in the course of this year? These are questions that have to be answered, affirmative questions that have to be answered on the tax return with a yes or no. You can't avoid answering the question. So are they going to go after teenagers? When they gather up all this data from these trading platforms, crypto trading platforms, they're going to have the names of every U.S. citizen that did business with those companies. And of course, they either have their tax returns, or if we're talking about young people, maybe they didn't file a tax return at all. And the IRS is going to very easily be able to send out a letter to all these people and say, you got to report your crypto transactions, and if you don't, we're going to check on you. What I anticipate, Bob, is that there's going to be a series of soft contacts before there's hard contacts. Now, the difference between a soft contact, and a hard contact is real simple. A soft contact is a letter from the IRS that says, dear Mr. and Mrs. Smith, we think there may be an issue on your tax return. We think that you might have made a mistake with this area. We need you to check your records, and if you made a mistake, amend your return and fix it. That's a soft contact. A hard contact is, you've been selected for audit. We're concerned about your crypto trades. We want you to bring in all of your records regarding your crypto trades, and we're going to go through them. So that's a soft contact versus a hard contact. Most of the people will get soft contact letters. A number of people will get hard contact letters. My guess is it's going to be the higher income folks with more capital gains trades that get the hard contact letters, and it'll be the younger people that get the soft ones.
One of the issues you talked about in your newsletter last month was when you use crypto to buy items versus using it as an investment. Talk a little bit about that.
Yeah, this is one of the key things that blindside people in the taxability of crypto, Bob. Okay, so let's take a crypto investment. I buy a crypto coin, let's say I don't care what kind of a coin it is, it doesn't matter. I pay $10 for the coin, and I hold it. All right, so now I've got an investment. I'm looking for capital appreciation, no different than a mutual fund investment or a stock investment, right? It's the same thing. Now, Let's say I buy that coin for $10 and I sell it for $12. Now I have a capital gain of $2 on that coin. That $2 capital gain is subject to capital gains tax. So it has to be reported on the tax return, and the tax has to be paid on the $2. Now, if I buy the coin for $10 and I sell it for $8, now I have a capital loss, and that loss needs to be reported on the tax return as well, because losses can offset gains. So if I've got a loss on this coin and a gain on other coins, they offset one another. I don't pay as much tax. All right, so that's the first type of transaction, is the capital gain. Now, I have my crypto investment. I've got my wallet over there that's got 10 crypto coins in it, and I use that wallet to buy goods or services. When I transfer the ownership of my coins to the individual that's providing goods or services to me, I've used my crypto to buy those goods or services. I've sold that crypto at an amount equal to the value of the goods and services that I provide, that I buy. And so the difference between the fair market value of the services and the coin that I purchased is capital gain income, and it's taxable. So if you buy crypto, if you use your crypto on the marketplace to buy a hamburger, all right, to buy a tank of gas, to buy the services of a house painter, you have a potential capital gain tax liability that needs to be calculated and reported. And people don't realize this, Bob, and they're going to get blindsided by this stuff. There's no question about it. People need to read that article in my newsletter to see exactly how these crypto transactions are taxed and what the mistakes are that people are making with respect to them.
Well, I'm just sitting here thinking about how in the world do you go about reporting that? It's a little bit of a one-step, two-step transaction. And it also makes me wonder how up-to-date most CPAs are on how to handle this.
Well, I can't speak for most CPAs. I can tell you that this is something that we pay attention to in my office and my staff, and we're tuned into it, and I do a lot of writing about it, as you well know. Mm-hmm. So we're up to date about it. But I think I got to believe that most CPAs know about the crypto problem because there's a question right on the tax return that they have to answer. All right, so if a CPA is preparing a tax return for a client, that CPA is going to have to know whether that client owned or traded in cryptocurrency, because the yes/no boxes have to be checked on page 1. Now, if there are trades in crypto, then that is reported on Schedule D as capital gains or losses, and maybe it's ordinary income, Bob. Let me give you an example. Suppose you are the one performing the services for the individual. Suppose you're the house painter, and you say to the guy, yeah, I'll paint your house for $5,000. And let's say crypto coin X, whatever that is worth $2,500. And the client says, yeah, I'll give you 2 of my crypto coin X's that are worth $2,500 in exchange for you painting my house. The house painter just received crypto with a fair market value of $5,000, and because the house painter is in the business of painting houses, that's what he does for a living, his receipt of that $5,000 worth of crypto is taxable as ordinary income. It goes on his business income statement as ordinary income, and he pays tax on it based on ordinary income. So depending on how the crypto is acquired will depend on whether it's considered ordinary income or capital gain income.
A lot of complexities to this one, Dan. It's going to be interesting to see.
Yeah, Bob, there really are a lot of complexities, and people can't go it alone. And I'll end the conversation basically the same way I began. Your crypto trades are not private. The IRS is getting that information on an ongoing basis, and the river of data is flowing into the agency, and it's going to be flowing nonstop, Bob. Don't think they don't know this stuff.
Once again, Dan's website, taxhelponline.com. Go check it out. A lot of free resources on the site. And Dan, as always, it's great to talk to you. Great to have you on the program.
All right, my pleasure, Bob. Thanks for having me.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. What a blessing to be able to have Dan on once a month to talk about the issues we need to know about. And, cryptocurrency, the trading of it. I was thinking about a story, and I need to check into this because it was an interesting story about one particular football player that I believe he got some of his compensation, either the upfront money or the actual compensation in crypto, held on to it. The NFL player held on to it, and then I think crypto took a huge hit, and he took a huge hit with it. But very complicated, a lot of complexities. Once again, taxhelponline.com. This is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.